Hi, accounting students. This is the second in a two-part series of videos looking at the advanced static costing example. So we're going to go and shift over to the example. Okay, here we go. So in this example, the actual level activity was 100 units. Budget was given as 80. That's not really relevant at this stage in the question because we know that the standard here is based on actual level activity, which is 100 units. They give us the breakdown of materials, £6 at 50 cents a pound, labor, 0.4 hours at $5, and variable overheads, double the rate, variable selling 50 cents, standard selling price at $20 unit, and then they give us our budgeted fixed manufacturing costs and fixed selling costs. Right, so straight away we know that certain variances will not exist. So we will not have any sales volume variance. So we can go and shade that out in gray. We know that selling variable overhead will not exist because that's based on the standard quantity, which is actual units multiplied by standard input, and there's only one sales commission per unit. Then we also know that for our fixed costs, we also do not have, if we're using variable costing, we do not have a volume variance. We just have an expenditure variance. So probably easier if we jump in and we actually go and look at those. The budgeted fixed costs were 500 and 120. So we have 500 and then we have 120 here. And so when we look at those variances, we are looking at the actual minus what it should have been. So in that particular case, it's 20. It's favorable. Why? Because what it is less than what it should be. And the same holds true for our fixed selling costs. If we take the actual, subtract what it should have been, it's a negative number. It's favorable because the actual is less than what it should be. So we'll move up now. We'll look at sales. Sales is easy because the standard quantity is just the actual quantity because there's only one selling price per unit. So here we have 100 units multiplied by the standard selling price of 20. So we have 2,000. The difference between these two, actual minus what it should have been, it's minus 200. It is favorable. Why? Because I've got more revenue than what I had planned. Okay, now we can look at materials. So we know the standard price per pound is 50 cents. So if we're looking at 50 cents for the materials, we have the actual quantity of 500 multiplied by the standard price of 0.5. Okay. And therefore that is equal to 500 times by 0.5, so 250. So let's look at our variance. We've got our actual minus our revised. It's 50. It is unfavorable. Why? Because our actual is more than what it should be. Now we're ready to go and look at our standard. So our standard is going to be the standard price of 50 cents multiplied by the standard quantity. And the standard quantity is based on the actual units we produced multiplied by the standard input. What is the standard input? Well, it should take £6 per unit. So we're going to multiply by 6. So that's going to be 600 times 50 cents. So that's 300. And our variance is going to be 250 minus 300. Actual is less than what it should be. It is a favorable variance. I'm going to go through the same process now with labor. If we take our actual hours of 45 and multiply them by the standard price of $5 a labor hour, we got 45 multiplied by 5. So 45 times 5, 225. What's the difference? 270 minus 250 for 25. It actual is more than what should be. It is an unfavorable variance. And we know that because we paid $6 an hour, whereas we should have been paying $5 an hour for our price variance. Let's go and look at our standard. Our standard rate is $5 an hour, and now we need our standard quantity. Well, standard quantity is going to be based on actual units, which is 100, multiplied by standard input. How many hours should it take to make each unit? And the answer is 0.4. And we'll have the same information here when we're doing our variable overhead. So times 0.4 is going to give us 40. So here we have got 5 times 40, which is 200. Our difference, besides the actual minus the standard of what it should be, it's 25. It is unfavorable. Why? Because our actual is bigger than what it should be. Otherwise, you could look at it. This is the efficiency or the usage. We took 45 hours to make these units. We should have only taken 40 hours. And the variable overheads is going to be the same sort of idea because it's based on the same number of hours. So we got 45 multiplied by the standard rate of 10, which is 450. And so the price variance, 360 minus 450. Let's just double check the rate. Yes, it is $10 an hour. It's 90. It is favorable. Why is it favorable? Because our actual is less than what it should be. How does that happen? Well, we're paying $8 an hour. We should have been paying 10. Over here, we have got the $10 an hour multiplied by the standard quantity, which is going to be based on the actual units times the standard input per unit, which is 0.4 of an hour. So 10 times 40, which is going to give you 400. Difference is equal to actual minus the standard. It's 50. It is unfavorable. Why? Again, took 45 hours, should have taken 40. Then finally, variable selling overheads. We are looking at the budgeted rate of 50 cents an hour multiplied by the units we sold, which is 100. You don't have to multiply by 1 because there's 1 sales commission per unit. So that's going to be 50. Our variance is equal to actual minus standard. And it's $10. And it is favorable because it was 40 cents an hour a unit. It should have been 50 cents. Obviously, we can add all this up and work out what the profit should have been. How else could we have worked out the profit? Well, if we do a calculation and we say we are looking at the selling price, which is 20, selling price at 20 minus the variable costs. What do we have for variable costs? We have $3 for labor, materials, 50 cents times 3 pounds. Then for labor, we have got 0.4 of an hour times $5, which is 2. And then double that for overhead, which is 4. Let's go down here. Minus 2, minus 4, and then minus 0.5 for the variable overheads, selling overheads. We multiply that by the number of units, which is 100. And then we subtract our fixed costs, which were altogether 500. And 120, and our profit should have been that amount. Again, you can check that by adding everything up. Let's just check the maths. That looks a little bit big. There we go. We have, again, this is the good thing about checking, as you say, does this sound reasonable? That sounds much more reasonable. Again, a little typing error there. Okay, so thank you everybody, and that is the second in our advanced examples.